Hey guys, welcome back to another video. So I'm actually doing this video once again. I did the video yesterday, but I felt like I missed out on some things that I wanted to explain to you guys. And so that is the reason I'm doing this video once again. And right now I am sorry if I speak a little bit slow, but I'm trying to explain everything in digestible terms to make it easier for anybody that's just starting out, that's trying to invest, or maybe trying to learn options. You know, I do it so they can grasp the idea behind the strategies that I teach. Now, here I'm going to use Apple as an example because I have 100 shares of Apple. I'm down on Apple, and this is actually a perfect moment to show you guys how is it that you can benefit from simply holding stock and being down on it. Now, a lot of people that are just starting out, you know, they see something like this where the account value starts going down on their stocks or their portfolio, and so they hit that sell button, they panic sell. And that is exactly the moment they lose that money. You know, you have to remember you never lose until you sell. Now, what you can do when you're actually down on the portfolio or ways of making money when prices of stocks are falling, there's various ways on it. I'm going to show you a few ways, some ways that I like to use. Now, I'm using the Robinhood platform because one of the strategies that I wish I can teach you here, but is not possible yet, is called shorting a stock, meaning you're borrowing shares from the broker, you sell them off, and you buy them back at a cheaper price. You give the shares back to the broker, and you keep the difference when the price of a stock falls, you know, as the price of a stock is falling. So that is shorting a stock. You can do it on other brokerages, just not on Robinhood just yet. So that strategy is excluded from this video. But the other strategies that I like to do is sell some covered calls. If you haven't watched my covered call videos, then check them out. Then I actually explain everything in simple, digestible terms for you guys to understand. Now, I'm going to show you something that I did here with Apple. Now, I have 100 shares of Apple, and there's a reason I buy 100 shares. I mentioned it in my last video. With Apple, you know, usually I try to go for day trades, and then if not, a swing trade, and then the 100 shares, having 100 shares, gives me that third option, that third play to start writing covered calls if I find myself in these kind of situations where I'm down. So in the meantime, I can collect some premium. And let me show you first what I did yesterday with Apple. I ended up selling a covered call. So I have 100 shares. I sold a covered call. Now, this is an out-of-the-money covered call. Expires October 23rd. And I got paid, me as the seller of the option, of the call option, I got paid $259 for it. Now, if Apple stays above $135 by last day of expiration, my shares would all be sold at $135, plus I made those $259. So that's still pretty nice returns. Now, there's a downside to doing this strategy, and I did a video on it as well. I'll leave a link down below for you guys. Now, this is selling out of the money covered calls because I paid $130.53. So I've been writing out of the money covered calls. Now, out of the money just means anything above what the current price is trending. Now, you can sell at the money and in the money covered calls and still be profitable and still collect a bigger premium. And I'm going to give you a few examples before I give you the other example on buying puts. Now, if I want to do, let's say, for example, assuming by September 18th, I think that Apple can easily stay below, let's say, $120 per share, right? I think that it's going to stay below $120 per share. I think that it can drop a little bit further down. Now, as you can see, the further I go out in the strike price for September 18th, the premium is really not that much for selling those contracts, $27. So the premium starts getting less. The only way that's going to get you more premium is if you go further out in time. But to me, giving the buyer more time for the price of the stock to move doesn't make sense. I don't want to wait that long. You can always buy yourself out of the contract, of course, but I'm going to keep it simple in this video. I like to do weekly, bi-weekly, monthly, maybe a month and a week out when I'm selling these covered calls. But as we're using September 18th as an example, you can see that the further out I go in the strike price, the less premium I'm going to be getting. So it's, $11, it's some money, but it's really not that much. And then the closer you get to the share price, or even in the money, anything below the share price, you can see that the premium is a lot greater. See, for selling a $115 call option on Apple that expires September 18th, I would get roughly around $600. Now, the strategies behind this, it's, let's say, for example, if by September 18th, I thought Apple can easily stay below $120 per share, below $120 per share, I would collect a bigger premium if I sold that contract compared to the further out of the money. You can see it $343. Now, the thing with this is that I bought the shares at $130. So even if I collect a bigger chunk of premium, I would be losing out on the capital gains. So it wouldn't make sense for me unless Apple did stay below $120 by September 18th, meaning I would have collected a bigger premium and my shares never get taken away. Now, the break-even price, it's $123.43. Even with the premium included, that's where the break-even price comes in, by the way. So if you were to sell your shares at $120, you would get paid $120 for each share, plus the premium that you collected. It's as if you would have sold them at $123.43. In this case, it would not make sense if my shares get taken away. So you get that, you take that risk that if you do get assigned to sell your shares at a cheaper price, you're going to lose out on those capital gains and that capital, basically. So in this case, it wouldn't make sense unless I was almost 99% sure that Apple was not going to stay above $120. It would have to stay below for me to keep my shares and make a bigger chunk of premium. Now, if you want to move, let's say, further into the in the money, right? So remember, I paid $130 per share. Right now, Apple's trading at $118 per share. But, I don't want to go for these little cheap premiums. Of course, you can if you want to, but look at that, $24 for September 18th. Now, let's say, I'm pretty sure tech stocks are going to sell off in the next 2 days. Let's say I'm pretty sure that they're going to do that. So what I would do if I was, let's say, 100% sure, I can say, hey, Apple is definitely going to be trading under $115 by September 18th. And I'm okay holding it. I don't want to sell with that loss, but I want to collect a bigger premium while I'm holding it. And if I sell that in the money covered call, yes, I would collect a lot more premium. You can see almost $600 in a premium. Now, the only way I would be profitable by selling this covered call is if Apple falls and stays below $115 by September 18th. If it stays below $115 by September 18th, I basically made all that premiums, over $600 for simply holding my stock. Yes, I would be down on the capital gains. Remember, I'm not selling. I will only be down on the gains and the capital. But I collected $600. My shares never got taken away, and I'm in it for the longer term. That mentality comes in again. I was willing to hold Apple, and I collected almost $600 right there. Now, Apple goes right back up after September 18th, and I'm back in it again. Stocks go up and down all the time. In this case, I would have collected a bigger chunk of premium. My break-even price is $121.10. Meaning that's technically as if I would have sold them at $121.10. And even though I paid $130 for them, I would be losing still on the capital gains if I get assigned If I get assigned to sell my shares at 115th, meaning Apple stays above 115th by September 18th, then I would lose money on that. Now, I wouldn't lose as much because I collected some premium, but I still would be losing some money on it. Now, that's in the money and at the money and out of the money covered calls. Now, let's move out to buying put options. Now, when you buy a put option, you're basically bearish. You think the price of the stock is going to go down, so you make money as the price of a stock goes down in price. Now, it lets you control 100 shares of the stock, but just like a call option, a call option gives you the right to buy somebody else's shares at a strike price between a certain amount of time. Now, buying a put option also gives you a right. Assuming on Robinhood you have 100 shares, it gives you the right to sell your shares at a strike price that you pick between a certain amount of time. So it obligates the seller of the put option to buy the shares from you. So because I have 100 shares of Apple, right? Let's say I have 100 shares right now of Apple. I paid $135 for them. If I were to buy a put option, let's say, for example, right? $135 put option. Now, when I describe put options, to me, it's like selling insurance. When you're selling, put options, it's like selling insurance. As the buyer, I'm buying insurance. So I would pay $1,735 to the seller. Now, the seller on his end, he's receiving my money. But now, if Apple stays below $135 or goes even further down, I have the right to make him buy my shares at $135. Now, remember, you paid almost $1,750. It's going to fluctuate up and down. The market is open. You paid $1,700, so you still have that break-even price. Just because you bought this put option and you can obligate them to buy them at $135 doesn't mean you're going to be profitable. You have to pass that break-even price if you were looking to exercise this put option. Now, the other thing that you can do is simply sell the put option. So when you buy a put option, assuming you don't want to exercise and you don't have 100 shares to exercise the put option on, you can simply sell the put option. Now, you don't need 100 shares to buy put options, of course. You can buy a put option at any price. And it basically gives you that right also, assuming you had the 100 shares. But a lot of people, what they do is simply sell the option back for more money if the price of a stock is falling. So let's say right now Apple is trading at $117. You see right there in the middle, $117.87. Let's say you think Apple is going to fall all the way below $115, right? So you can go on there, buy one put option. So for $305, this contract is letting you control 100 shares of the stock. So let me explain it this way. It's a contract. You have the right to sell your shares, assuming you had the shares, or you can just simply sell the option for more money. So those are the things that you can do. Now, if Apple falls below $115, obviously this contract is going to be worth a lot more than $305. So let's say now it's worth $500. So all you would do is to close the position, you would sell the option back and pocket that difference. You paid $305, but you sold it for $500, so you made a quick $200 right there. But a lot of people, I don't know if some big investors or not, they buy put options. Maybe they buy them to give themselves that insurance to protect their accounts. That is one way that you can use to give yourself some downside protection with buying put options or making money as the price of a stock is going down. And same thing with the covered calls, in the money, out of the money, and at the money covered calls. So there's lots of different strategies that you can use to give your portfolio some downside protection and even make money on it. Now, I think that anybody trading, anybody that's even, let's say, buying and holding, even if it's for a dividend income, for passive income for the long term, which is what I'm doing, in my opinion, everyone has to learn some options. It'll give you a better idea, a better grasp as to how you can even protect your account when your stocks are falling. But I wanted to make this video in a better way, give you guys a little bit more detail on everything. If you guys have any questions or comments, leave them down below. And until then, I'll see you guys on the next video.